Great. All right. Good evening, everyone. Yes, thanks for coming on a World Cup match evening. And yeah, like Anima said, so my background is in economics and finance. So I did my master's in I studied politics, philosophy, and economics. Then I did my master's in economics for 2 years at Oxford, and then I went into finance. And I worked at Goldman Sachs for 5 years doing equity research, which is basically where you have clients who are hedge funds and pension funds and the likes of LSIV, and you tell them what to invest and where to put their money. And yeah, I left 2 years ago in large part on the back of what happened after October 7th. Not that it should have been surprising, but just the way that things became like blatant and were handled. And yeah, since then, one of the kind of key things I've been doing is working alongside allies within the financial sector to kind of support divestment campaigns. And, I guess in one sense, you can kind of define it as like trying to be like a translator between the worlds of activism and capitalism or finance. And yeah, so I'll leave it there for now in terms of like background, but that's where what I'm gonna be sharing is coming from and the kind of like perspective I'm trying to bring to this conversation. And what the presentation kind of intends to do is that I think the last few sessions kind of establish the political landscape and the Shake the Civ campaign goals. And today I'm going to focus a little bit more on like the nitty-gritty bits of the finance and like what does the different kind of lingo mean, and also how can we think a bit more tangibly about some of these things that get thrown around, like we can invest ethically and we can still make a profit. What does that actually look like when we have it in like evidenced ways and we really say it with a lot of confidence? And yeah, I mean, feel free to at any point stop me if something needs clarifying or you'd like to make a point about something that I've said. Um, so, so I wanted to kind of start by naming something that I think needs to be pointed out, which is that I think a lot of what economics and finance gets packaged as is something that's kind of very intentionally designed to alienate and complicate and make it framed as a kind of leave this to the experts kind of field. And I think that's done very intentionally because it kind of overwhelms and it means that people are intimidated by the thing and they think, okay, like maybe this is not for me and like this is this area. And the first way that I think we can dismantle that is to start to understand that when you break down a lot of these concepts, they're actually quite simple things that we can all understand by kind of operating in the world. And we should, I think people should feel emboldened to ask these questions when they're meeting with their fund managers, or when you're speaking to someone who, works at whatever bank and thinks that if they speak in a certain way, that's going to create an air of complexity that makes people feel like they can't respond. And so I kind of laid out a bit of the jargon that I think gets thrown around. It's definitely not mutually exclusive. And if there's something that you feel I've missed that you also would like to find, please do say so. But I just thought it would be helpful to go through some of these terms and explain what they mean, because I think they get used a lot in exactly that kind of way of which is intended to intimidate and disempower. So the first one is the market or the financial markets. Markets are spaces of exchange. Financial markets are no different. They're just different types of markets. You have stock markets, bond markets, and essentially those are all different spaces where you have buyers and sellers. And typically, you would have the people and institutions who have money that they want to invest. So that's from individuals like all of us to pension funds, hedge funds, sovereign wealth funds. So they can get bigger or smaller. Like a sovereign wealth fund is something like Norway's oil fund, the money they make out of oil, and they're deploying that money. Or, like you have a pension fund like the London Councillors pension fund that this kind of campaign looks at. So a lot of it is these kind of players being like, we have money and we want to grow it. And then you've got companies and governments who need that money to operate and grow. And so either sell parts of their, like as a company, you'd sell part of your company, which is a share, or as a government, you would, borrow money from those people, which is how bonds work. Essentially, it's the government saying, I'm going to give you this money. I'm going to take this money away from you, and then in a year, I'll give it to you with 5% interest. So within that, you have something that's called, have people heard the term ETF thrown around, exchange traded funds? It gets thrown around a lot. ETFs are just, a basket of companies. And the idea is you spread the risk by holding a bunch of small portions of different companies instead of, like one specific company and being exposed to whatever happens to it. An index tracker fund, it's a fund that basically, okay, so I think this one's actually quite important because a lot of what I've heard get said and get like the pushback people get is points about passive and active investing. And I think it's important to understand what an index tracker is, to understand why these pushbacks from fund managers aren't actually as solid as they seem. So an index tracker is basically a pre-existing list of companies. So they're just a grouping of companies that are lumped together, and it's called an index tracker. So for example, you would have like the S&P 500, like the 500 biggest and most profitable companies in the US, or the FTSE 100 is the 100 biggest companies in the UK. And you can kind of think of it as like a shopping list. So it's not that, so you can go to the supermarket and you can pick a bunch of things and you can do that freely. And that's kind of like active management. So if you think about like the passive versus active management, or you can go to the supermarket and you have a shopping list with you and you're only getting the things on the shopping list. So that's what like an index tracker is. It's that shopping list. And it doesn't mean that you have to take that shopping list to the supermarket. You've chosen still to take that specific list. So when fund managers say things like, well, this is just a tracker or this is just an index and we are just tracking the market, that's not actually something that they have no choice on. They are choosing to track that specific fund or choosing to track that specific market, and they can make equally a choice to track a different fund or to track a different ETF. So I think that that kind of distinction is important. And it feeds into that point about passive versus active management, which is just passive follows a list automatically, and active involves human stock picking. So back to that analogy about the supermarket. So when you're following a list, you can choose which list to follow. And pooled funds, deemed pooled, I think a lot of that would have been covered in a lot of the conversations that have already been had. But I think the point I wanted to make there is that there's always someone holding the other side of the contract. So when points are made about how, like, well, this is out of our control, or investments are, these investments don't sit with us, it's important to understand, okay, well, then who's on the other side of that? Because if BlackRock or LNG or whoever is running that money, that doesn't mean that they're making the decisions behind it. It's either the LSIV or it is the council themselves. And so there's always going to be someone else sitting on the other side of that contract. And that is the person that you want to be kind of, campaigning and working on. Investment horizon, I wanted to make this point because, again, I think that gets used a lot, specifically when talking about pensions, and it gets confused with holding period. So investment horizon is the very kind of like, with pensions, the very kind of long dated horizon, which is how they're targeting or how they're thinking about when they need to pull the money out. So that would be like 20 to 30 years with pensions, because that's when people are retiring and they need to pay out that money. And they have a goal that over these 20 or 30 years, this is what I want to generate. That does not mean that every time they buy a stock, they hold it for 20 years. That's the holding period. So a typical pension fund, yes, it's targeting a 20, 30-year investment horizon, but their average holding period is about 2 to 5 years. So you still have a lot of movement and a lot of shifts over that kind of 20 to 30-year period. And there is a much slower pace than, say, at a hedge fund where they're flipping things around within a year, but it's nowhere near decades. So I think that distinction is quite important. And it can work, like for us or against us, depending on the context, because sometimes they'll say, well, when that thing turns, then we will sell. We don't have to wait the 30 years. But equally, the money is not as kind of frozen as it might be implied to be. Alpha and beta Sharpe ratio, I don't know if these things necessarily come up, but again, like if these things get thrown around, alpha and beta and Sharpe ratio, these are all just different ways of thinking about risk and return. And if someone kind of throws that word at you, feel free to be like, well, what is alpha? Because alpha is simply, okay, the overall UK market went up by 10% and I went up by 12%. So my alpha is 2%. It's just how much I beat the market. And beta is a measure of volatility. So it's like if a stock is very volatile, then they say it has high beta. Again, I don't know to what extent these kind of nitty-gritty details come up, but I think the more that conversations develop with fund managers, the more these kinds of words get used to create a sense of kind of disempowerment. And I think taking back our agency is about feeling like you can just ask if you don't understand something, and B, knowing that a lot of these terms, when you break them down, they are comprehensible to people. You don't have to have, worked at whatever bank for however many years. Okay, so I just wanted to start with that because it's something that let me just go back, because it's something that I think is quite important in terms of how we think about our positionality versus the people that are running the money or controlling the money. The second thing I wanted to speak about was that point about, will my money make a difference? I think that's come up a lot. And I think a lot of conversations around divestment tend to be like, well, but we're a really little bit of the overall market. And will that even cause a dip? And I think sometimes we get too caught up in the dip logic. And I want us to kind of think about what it means to move beyond that dip logic and to think of divestment as part of a much kind of broader strategy and broader movement. So this chart up on the top right, it might look kind of complicated, but all it shows is people will be aware that, Caterpillar last year, the Norwegian Sovereign Wealth Fund divested from Caterpillar. So they sold their stake in Caterpillar, and that got a lot of news. Now, Norway's sovereign wealth fund is the largest in the world. They have over $2 trillion in assets. The day it divested is that day on the white line. There was a small dip. Caterpillar has still gone up. Now, the last thing this is intended to do is to suggest that divestment is not important. It's kind of the opposite. It's to say, look, the market has become this beast, and to force change through it, we have to not be naive in how we understand it. And we have to understand ourselves as kind of part of a cumulative story that is still unfolding. And if you don't cause a dip, or you cause a dip and then it changes, that does not mean that divestment isn't working, because divestment life cycle is much larger than that. It's more about, setting the precedent. So first you have the selling, then you have the noise, then you have the precedent that sets for others. And then you have the kind of narrative of ostracization. And that's what kind of builds and builds to create a story of which stocks or which markets become eventually untouchable. But it is a longer story. And to demonstrate that point, again, I've overrun, but yeah. So this is a timeline of political action both in the UK and the US, and corporate or market action that was happening alongside that during the time of apartheid. And it's kind of to demonstrate what I'm kind of calling the divestment cycle, and it's to show how these things work out in the larger time scale. So you can see here that, the anti-apartheid movement was set up in 1959 in London. The first campus divestment in the US didn't happen until petition for divestment didn't happen in the US until 1965. It then took another 15 years. 1980 is when we had the first non-binding divestment law, state law in Nebraska. And then only a year after that was Sheffield City Council, the first council in the UK to divest. And once we hit the 80s, then things started to snowball quite quickly. And you started to see a lot more action before, apartheid essentially started to fall apart in 1986. Now, at the same time as that was happening, up until 1980, in 1980, the CEO of HP said, I'd rather lose business in Nebraska than South Africa when the divestment happened. US loans in to South Africa peaked in 1980. And then within 5 years, as the kind of political landscape started to shift, this collapsed very quickly. Companies were tripping over each other to leave and losing lots of money in the process. So, the shutdowns you hear about, how these things don't work and markets will be markets, they're not new. That's the way things have always been. And quite often the way it happens is it happens very slowly and then all at once. And so one way to kind of see that in numbers is you can see the company losses in apartheid South Africa. It's not a new thing that companies and markets often are the last to move because they hold on to this kind of like capitalist narrative of profit, profit, profit. And then what happens is the political dial shifts very extremely at some point, and then everyone is fighting to leave. And so what this chart shows you is what each of these companies, I mean, you can see here, first of all, at the bottom, the dates, they all exited. And it wasn't until 1986, which is essentially when, sanctions had been imposed and apartheid was basically falling completely apart. And they lost anything between 50% to 100% of the value of the assets that they held in South Africa. So whatever they had initially paid for it, they sold it. Either they had to actually, in some cases, like the case of GM, pay money for other people to take over the debt they had in South Africa, or they sold it for like near zero because they had to get out and they had to get out quickly. And the landscape had shifted quite extremely and they didn't have time to actually gain a profit. You have on the other side of that in 1983, Chrysler left, not for moral reasons, I should say, but they sold at market price. So yeah, again, you saw this in Russia. So in Russia, foreign investors lost $107 billion in Russia on one estimate, because as soon as there's always a lot of buildup, but no one moves until they attacked Ukraine, and then everyone pulled their capital and they had to sell at like really low prices. So it's not a new story. It happens, and that's not what should be. The way companies react to these things, it has always been this way, and it should not paint a picture of that this is not effective or this is not something that will ever be relevant. I mean, you can tell this same story in lots of different ways. So again, here, looking at coal and looking at tobacco, you can see that for a long time they were doing well. So that like the top chart is showing you on the gold line is how coal has performed, the whole coal sector, and the white line is the US market overall. And so what you can see is that things are going well, and then at some point they stop, and you don't want to be the last person left on the dance floor. And once they stop and they turn around, they often turn around quite extremely and persistently. On the bottom, you can see tobacco. So these are the two largest, the ones in yellow and the one in gold are the two largest tobacco companies in the US. So they were kind of moving in line or above the overall US market. And then you started to see a shift. And since then, they've underperformed by quite a margin. So, things don't turn until they turn. But once they turn, they stay that way. And so, yeah, I think it's good to think about where we are in that kind of cycle and to not only look at the past as a kind of signifier of the future. And then on the final point I wanted to make on this, like kind of thinking about this idea of, is it financially prudent to invest ethically, is a kind of less extreme story than the one with tobacco, coal, or South Africa and Russia, but it's just looking at things like indices. So an index, like I said, is the kind of basket of companies. So here you can see the white line is MSCI World Index, which is just a basket of the 1,500 of the biggest companies in the world. And the gold line is, again, a basket of 1,500 of the biggest companies in the world, but excluding fossil fuels. It's outperformed consistently since 2011. The bottom one is showing, again, the kind of overall world index, and then one excluding business interests and fossil fuel. And business interests are controversial weapons, tobacco, alcohol, gambling, adult entertainment, fossil fuel activities and kind of stocks that have like really bad ESG ratings. Again, since its inception, it's 2020, it's consistently outperformed the market. So it's equivalent that doesn't have these exclusions. So yeah, you've got kind of two different ways of looking at it. One is like you have these indices that have done better, that are kind of built on ethical grounds. Now, if you kind of look into what's in these indices, probably by a lot of the metrics that we use, you'd still find a lot of companies that are problematic, but they are more ethical than the overall market and they've outperformed. And then if you think of it from the lens of the coal, tobacco, Russia, South Africa story, you see that even these problematic ones that get missed in indices like these, once things turn on them, they turn quite extremely and quite quickly. This is just like a more kind of detailed look at these two indices. And so the blue lines again show the ones with exclusions, which have outperformed. You can get this data very easily just from just by Googling, and they publish all these results. And so I think what I thought I'd do now is I think it can be helpful to understand how these dynamics work by narrowing down on a specific company and looking at what does it mean when we talk about like uncalculated risk, or when we talk about these ideas of like once things turn, the company will lose a lot of its money. What does that actually mean? So this was a report on Airbnb that we published last year, and we circulated that within various traditional finance spaces. And I think it helps to show in kind of less abstract terms what a lot of these things we're talking about are. Okay, so the way that this is framed is quite similar to how, we would frame arguments if we're like how I used to frame arguments at GS, or when you're talking to clients and you're saying, like, I'm going to tell you a story of why I think that there is something financially that is being missed by the company. And as a consequence of that, I think that they are going to suffer losses or they are not making the right decision. And so a lot of kind of what is happening within the market is people having different opinions and taking different views about what they think is going to happen, whether that's at a sector level or at a company level. And then based on that, buying and selling stocks. So the story and the kind of narrative of what we did with Airbnb was saying, look, there have been significant shifts in attitudes on Israel. So you can see kind of how that has changed in the US on that chart on the top left, which shows just amongst different groups the kind of percentage of supporters over time. And then saying, okay, now let's look at Airbnb. We show that Airbnb is actually generating not very much money in Israel. So that's that first red part, relative to its presence in markets that have high risk of boycotts. So that's the green bar. And it's definitely not generating that much money in Israel relative to markets who have high regulatory risk, which is the blue bar. And I can or can't go into, depending on how are we doing for time. I think we're okay. So in terms of how we think about like regulatory risk and boycott risk, it's kind of having different basis for it and different framing, being like, this is the precedent we've seen. And as a consequence, we think that they do have a certain amount of risk, say, in Arab countries, because that's where we've seen lots of different boycotts having quite significant impacts. And then the countries where we looked at them having quite significant regulatory risk were the signatories at the Bogota conference who committed to sanctions against Israel. So we show basically the total income at risk in all these countries, and we also show that they're not growing very much in Israel. And then from there, the story is kind of like saying, in the top left and across these three charts, is having different scenarios around how much money they would actually lose. Say at the top left, it's if we do start seeing the Bogota signatories impose rules on companies that operate in Israel. And that's just a range of different scenarios, which are based on some of the things that we've seen in Spain around limitations on Airbnb listings. And then the chart on the right shows you how
Wait,
much.
could you just tell us what Bogota signatory states are?
Yes, I off the top of my head, what was it? Turkey, Colombia. I mean, I can look them up. I don't remember all seven. I don't know if anyone remembers all seven, but I can look them up now.
Oh, it's okay. So it's basically seven states. Okay.
Yeah. Yeah, and then there was one that happened after the conference. So Ecuador, Colombia, Brazil, Congo, and Turkey, I think. Um, So these are countries that signed a set of commitments to place sanctions on Israel, and that happened. I think that took place last year in 2025. So the kind of story that we tell around Airbnb is saying, look, you're generating something that is really not very significant in Israel. And if we see boycotts of anything near the scale that we saw in the Middle East on things like McDonald's and Starbucks, which is what we show in the top right, and that's all real reported data by Americana Group, who operates a lot of these companies in the Middle East. So, you saw boycotts scale of anything from 10 to 50% on all these operators. So we say, if you see 10% boycotts of Airbnb in the Middle East up until 40%. So following that same range, that's the chart at the bottom left. And we scale that against the revenues they're generating in Israel and show that they're actually generating more revenue there. I've just noticed there's stuff in the chat. Have I missed any questions?
I think you can proceed and we can deal with the question at
Yeah.
the end. Yeah.
Okay. Yeah. And then the third and final scenario was just looking at also what it would look like if we start seeing significant boycotts from young people, because those tend to have been the group that's been most documented to be quite active responders to boycott movements, and they also happen to be Airbnb's highest growth segment. And so, all in all, it kind of comes to tell a story of not what the reality is now, but it's to say, look, if all these combined risks do take place, what you're risking is 4 times the revenue that you're generating in Israel and more than 200 times the revenue you're generating in illegal settlements. And that just by any kind of measure of financial prudence, that is not the correct decision for a company to make. The story is a little bit more complex in the sense that Airbnb, for example, uses a lot of Israeli tech. They did exit illegal settlements in the past and had a big political backlash. But it just goes to show that a lot of these decisions are not actually being made by companies on a kind of financial basis of like, this is the best decision for us to be making as a company, but rather because of political forces. And whether it is the risk that they see now or the losses that they would see if they had to exit in the same way that we've seen exits happen in previous kind of targets of boycotts, from a financial perspective, it's actually most often not the correct decision. So that is just saying a lot of kind of what was already been said. So is talking about how a lot of what we're doing when we're thinking about buying and selling stocks is trying to kind of identify these things. And so when you've got a very big missed risk like this, it's not something that should be insignificant to a fund manager or a portfolio manager. Yes, let me move on. Okay, so the bit I kind of wanted to go to start to kind of close up is talking a little bit again about questions to ask at pension meetings. And this is back to that theme of that I kind of talked about at the start of the presentation of not letting fund managers intimidate and disempower. And so some of these questions are intended, to actually understand what they're doing with your money, with our money, and some of these questions are also to just hold them accountable and establish that kind of line of accountability. So, understanding what kinds of returns they are targeting and what kind of returns they have made, because a lot of the times they will say that that they're targeting certain returns, but actually you want to ask them, have they met these targets previously with these kind of existing investment strategies that they're talking about? For each of our assets, who's the legal counterparty to the contract, and how will that change with new pooling rules? Back to that point about like always thinking about who's on the other side of that contract and not letting the ball constantly be passed around. So to really try to understand, okay, who's the person in the end that is talking to? Like, let's say it's not ELSIV or it's not the council that's having that conversation. Who is having that conversation with BlackRock or with LNG or with whoever is actually then controlling the money? Transition fees are something that I don't know how much they come up in these specific types of meetings, but there's something that do get brought up in a lot of these types of settings as a way to kind of disincentivize or say we shouldn't move things around because, it would be quite expensive. Asking for specific numbers around that, quite often it does get overstated, and it gets used as a kind of vague shutdown. And it's also a way to establish understanding and to, be like, I understand what's happening here and we can have this conversation as equals rather than you just shutting me down with these kind of, by throwing around these things that are supposed to be there to end conversations. I mean, I think this one maybe people would already be aware of, but just Israel's credit rating has been downgraded. So this is one specifically when we're talking about bonds. Israeli bonds is what is the counterparty risk? Counterparty risk is basically the risk of the Israeli government not paying back their debts with these kinds of exposures. And that's a risk that councils should be willing to answer to if they're holding government bonds that are associated with very high risk states. And that's not according to anyone's, opinion. It's according to agencies whose whole job it is to assess these kinds of risks. And the final one, what is your formal process for identifying and assessing new categories of financial risk across our holdings, and how regularly is it reviewed against our portfolio? I think even if we talk about I know there's new ISSs being developed, and there is a kind of framework about how, in theory, the pension committees or fund managers should be thinking about risk. But quite often what happens is that these things get kind of written up and then ignored by the fund manager. And there should be a mechanism of review, and this also happens within very large funds and within very large companies, is you have like a kind of like stated risk framework or stated ethical framework, and then you do that once when you initially create it and you don't revisit it and you don't review it. So understanding what that review process is. And just to close, I wanted to say that there is a lot of work that is being done on these fronts by people from different perspectives. So, the Airbnb report that was written with 40 Securities, who are doing a lot of this work from inside the kind of financial world and producing financial analysis on risks that aren't being accounted for. There's also people doing research in Norway, because Norway's sovereign wealth fund has paused their ethical investment strategy. The third and fourth bullet points, these are funds that were explicitly grounded in exclusions of, for example, not investing in companies that operate in the occupied territories, and companies that are designed around social justice. So these funds actually exist. So when that question gets asked of like, okay, you want us to sell, but what are we going to buy instead? Well, there are things that you can buy. Now, this is very like nascent new area of having like really very strictly defined ethical funds. So not just like, excluding fossil fuels or excluding gambling, having funds that are actually building in quite strict exclusions, but they do exist. And they have not, so for example, jury was just set up. So we don't have performance data there. It was only set up this year. The JSTC, that's a fund that was set up in 2020. Now it has underperformed the market, but it still generated 10 to 20% returns over the last few years. Yeah, and then there's Heartland Initiative, are just again another organization that are working on translating human rights risks into like financial risk. So if that's something that ever becomes the shutdown, or you're like looking for resources or seeing yourself face that blocker, there are, pockets of the financial world that are offering these types of ethical investments. And also there are people who are willing to have these conversations and to kind of resource you with the knowledge and the kind of financial grounding that you need. Yeah, I think that is where I will stop. Sorry if I went a little bit quickly in some parts, but yeah, I'm happy to take any questions, and I'm sorry if I missed ones. Please just feel free to like unmute and ask whatever you wish to ask.